बेंचर्स तो बैक बेंचर पीछे बैठ के आवाज क्यों निकालेंगे। Apportionment.
Good evening, everyone. Welcome to our next session on GST Back to Basic series. In the last lecture, we had understood the provisions of section 16, which wherein Parth explained the provisions where you can claim ITC. In today's presentation, we will understand various provisions which require us to apportion our credits between various baskets, whether it may be in relation to exempt activity or it may be in relation to non-business activity. So provisions pertaining to section 17(1) to section 17(4) deal with this specific apportionment rules. Section 17(1) deals with business versus non-business. It says that ITC, which is partly used for business and partly used for non-business, should be bifurcated. Similarly, section 17(2) deals with ITC used for exempt versus ITC used for taxable or zero rated activity. 17(3) deals with inclusion and exclusion from the exempt value. And 17(4) is a special rule for banks and financial institutions and their proportionate ITC to be claimed. So, firstly, section 17(1) deals with the provisions wherein it says that where goods or services which are partly used for business and partly used for other than business purposes, then the ITC will be restricted only to the extent which is attributable to for the business activity. So here the intention of the lawmakers is to restrict your ITC. Here the intention of the lawmakers is to restrict your ITC which is in relation to non-business activity. So understanding that how do we identify and what do we mean by non-business, it is firstly important to understand the meaning of the term business and thereafter the meaning of the phrase used for business. So the definition of business is given under section 217 of CGST Act. I have taken the first 4 clauses which are relevant for us. If you see the definition on a plain reading, it becomes very evident that the intention here is to cover a wide spectrum of activities. See, when it comes to taxability, again we have to refer taxability on my outward supplies. I have to again refer to the same definition. And at times the department has taken a position in various advance rulings that this definition is very wide, and therefore it covers even a single one-time activity or even an activity which may not be in my regular course of business, but I am doing it as a part and parcel of my business, may or may not be for any profit. So on a similar footing, I have to look at the definition from a wider spectrum when it comes to input tax credit. So I would believe that here, if you read clause C and clause D specifically, it says that any activity where there is no volume, no frequency, or there is no regularity also. It also says that activities which are in relation to goods or services in relation to commencement or closure of business. So all these subclauses of the definition of the term business make it a very wider term to mean that there may be many types of expenses which may be covered in the definition of business. So what do we mean by the scope of the term used for business? Once we identify whether any expenditure is in relation to business or not, the term used for business, the term used specifically, has been interpreted in the past also in our expenditure, whether it is used for business, whether it is required for business or not, it depends on each case to case. There have been decisions where it has been specifically held that the term used for business means direct or indirect nexus with the business. The procurement of your the procurement of your goods or services should have direct or indirect nexus with your normal business activity. Whether a linkage with outward supply is required for each expenditure, my answer would be no, because your section 16 or section 17 does not say that each of the procurement of my goods or services should be specifically linked with my outward supply. For any expenditure, it should merely satisfy that it is used for my business activity. It is required for my business activity. It is very much essential for my business activity. If all these conditions are met, then definitely you can claim ITC and it can be said that it is used for business. As I said, the term business covers activity in relation to closure or commencement of business also. So commencement of business, why it is important is because at the stage of pre-incorporation, the business has not started. But still, the definition of business says that commencement of business is also a part of business. So it means that any expenditure which is incurred in relation to commencement of business, though my actual business activity has not started, can be said to be used for business activity. Because the intention of incurring such expenditure is to ensure that a business which is to be started in future. So all these expenditure are incurred for a business which is intended to be started in future, and that is why it is to be interpreted that it has a nexus with my business activity, which will begin in future. Similarly, expenditures incurred in relation to closure of business. So there may be certain legal expenditures incurred for closure of business. In all such cases, also one can interpret that the definition of business is very wide and it covers activity related to closure also. Therefore, any expenditure incurred for closure of business, definitely some ITC, the ITC which is relation to such expenditure can be claimed. Thereafter, it is possible that under a similar, under one PAN, under one business, I may be running various business lines. And for example, I may have a hotel chain, I may have a rental activity, I may also have some manufacturing or trading activity under the same PAN, under the same GST, and I may have business verticals. So is it required that the procurement which I make for goods or services has to be identified or bifurcated against each business vertical? And can I claim ITC against the expenditure incurred for a particular vertical? The ITC should be claimed only against the income generated from such business vertical? The answer is no. There is no restriction under the provisions of GST law. It merely says that your expenditure should be for business. It can be any business under the same PAN, under the same GST number. So this means that I can use the ITC generated from one business vertical for paying my outward liability of another business vertical. Because here a general common pool of expenditure is created for the purpose of claiming ITC and for the purpose of utilizing such ITC to make payment of my outward liability. So there is no restriction that the vertical wise ITC should be claimed or vertical wise records should be maintained to claim ITC. The law is very clear that the ITC should be used for business. It can be any business vertical, and it can be the ITC can in fact be used across across other business verticals for paying my outward GST liability. Then what about the CSR, that is the corporate social responsibility expenditure incurred? There is a huge debate going on whether such expenditures are in relation to business or whether it is used for business or not. See, there are two laws which are very much conflicting. The Income Tax Act clearly says that we will not treat such expenditure as business. Whereas the Companies Act and the rules and the CSR rules thereof clearly said that this expenditure is in continuation of the business. Moreover, the Companies Act, which is a statutory which is a statute which mandates me to incur such expenditure, can the department say that this expenditure is not in relation to business? Because non-compliance of Companies Act would definitely hinder my business, and therefore I have incurred such expenditure for running my business smoothly and for ensuring the statutory compliances. Therefore, there is a big debate whether the CSR expenditure are in relation to business or not in business. We feel that the department should come forward and clarify this. However, there is no clear-cut answer. There are various advanced rulings also which have given different views, but there is no clear-cut answer as of now whether such expenditure is in relation to business or not. So this is a slight gray area where each of the assessees should tread very carefully. Thereafter, the term used for business, we believe, would specifically exclude certain personal expenditures which are incurred for the directors or the partners or the proprietors. Maybe it may be some traveling expenditures or expenditure in relation to their motor cars or mobile phones. Of course, identification of such expenditure and bifurcating them into business versus non-business may be a bit problematic, but there are certain provisions which help us in deeming certain amounts as ITC used for non-business purpose. We will understand that provision in the next few slides. However, here it is important to understand that such expenditure have to be highlighted, and accordingly we need to take a decision whether I can claim ITC or not. We need to establish that the expenditure incurred for the director or the partner or the proprietor was for the business or not for the business. If it is for the business, then definitely you can claim credit. If it is not for business, or if it is partly used for business and partly used for non-business, then there is a bit of a problem over there, and we need to bifurcate such expenditure and accordingly decide whether we should claim ITC or not. Thereafter, there are expenditures incurred for guest houses or accommodations for employees. Even sometimes motor cars or mobile phones are given to employees. Then what should we do? Whether these expenditures are in relation to business or not in relation to business. So, under the erstwhile service tax regime, there are various decisions which say that if the guest houses are used as an alternate means of accommodation for employees traveling or employees staying for a specific project in a state or in a location, then such expenditures are to be treated in relation to business. Even mobile phones and even motor cars, in some cases it has been held that it is in relation to business. But we know that there is a specific block credit for motor vehicle, and therefore accordingly motor vehicle could be a challenge for claiming ITC. But other cases like guest houses and mobile phones, definitely if you can establish that it is in relation to business, you can claim the input tax credit. Then section 17(2) specifically talks about cases where goods or services are used partly for exempt supplies and partly used for taxable and exports, that is zero rated. So here the provision states that the ITC will be restricted only to the extent where attributable for taxable or zero rated supply. So ITC, here again we are talking about a scenario where a particular procurement of goods or services, the goods or services are used partly for exempt and partly for taxable and zero rate. So here we know that there is a complex formula given by Rule 42. The empowering provision of Rule 42 is section 17(2). Section 17(2) says that your ITC will be restricted only to the extent which is attributable to your taxable activity and zero rated supply. Now, when goods or service are used partly for exempt and partly for taxable, how do we identify the eligible portion and the ineligible portion? For that, the government has prescribed a very complex formula in the mechanism of Rule 42. The next 3-4 slides will understand this formula in detail, because for all entities providing exempt supplies or providing non-business activities also, ITC claim a non-business activity also, this formula becomes very important to decide what is your eligible ITC. So here we first identify the ITC which is to be credited to your electronic credit ledger. Here C1 denotes ITC credited to electronic credit ledger. Now, how do we identify this ITC? For this formula says that first take your total tax paid on your procurements, that is your total tax appearing in your purchase register. From this, you subtract the ITC which is exclusively used for non-business purpose. You subtract the ITC which is exclusively used for exempt services or exempt supplies. And also you need to subtract the ITC which is blocked under section 17.5. That is your ineligible ITC, specifically like motor cars or your food and beverages. So these are some examples. So it says that take your total ITC, total tax paid on your procurements appearing in your purchase register. From this total amount, subtract your ITC exclusively used for non-business, ITC exclusively used for exempt supply, and your block credit. The amount which will you derive after doing the subtraction is considered as C1, and C1 is denoted by saying it is ITC credited to electronic credit claim. Now then what we have to do is, from this C1 you have to subtract the ITC which is exclusively used for my taxable or exports activity. So there may be certain expenditures which can be identified that it is exclusively used for taxable activity or it is exclusively used for exempted activity. So in all such cases, you have to subtract that ITC from the total credit, and from this we will derive C2, which is said to be common credit. So what does this mean? I would like to pause here for a minute. This means that for my each line of item in my purchase register where I am claiming ITC, I need to put a tagging that whether this ITC is T1, T2, T3 or T4, which means that I need to identify for each line item of my invoice whether it is used exclusively for non-business, whether it is exclusively used for exempt, whether it is blocked, or whether it is exclusively used for taxable or zero rated supply. Once you identify this, then whatever is left out is your common credit, which means the common credit is that pool of credit which has no identifiable income against such expenditure, no directly attributable income against such specific expenditure. So this ITC will term as common credit, and here it is specifically denoted by C2. Now what do we do with this C2? The next step is to bifurcate this C2 and claim proportionate credit. How do we do that? Here it says that when we read D1 is the ITC proportionate, the ITC attributable proportionately to exempt supply, because I may have a total turnover of, I may have some exempt turnover and some taxable turnover, and I need to now attribute the ITC which is towards exempt supply. So how do I do that? I take the common credit, which is C2. I multiply this by my total value of exempt supply and divide by the total turnover in that particular state. This will give me the ITC which is attributable towards my exempt supplies. So here what we do is in fact, in short, if I say, we do a proportionate claim of ITC. We identify the proportionate ITC which is attributable to exempt supply, which is denoted by D1. So just repeating the steps. First, we took the total ITC, we subtracted the ITC which are specifically attributable to taxable, exempt and non-business. From this, we derived the common ITC. Thereafter, from this common ITC, we identified the credit which is attributable to exempt supply by doing a proportion of exempt to total turnover. This proportion is denoted by D1. Then in the next step, we identify then what is my eligible ITC. Eligible ITC is the formula says that C3 is equal to C2 minus D1 plus D2. So we know C3 here is eligible ITC. C2 we know from the earlier slides, it is the common credit, the common pool of credit which is not identified against any of my specific income streams. So C2 minus D1. D1 we just derived from the earlier slide. D1 is the ITC which is attributable to exempt, the proportionate ITC attributable to exempt. And we should also minus D2. D2 here means that here the law says that 5% of your total common credit should be deemed as non-business ITC. So if you have any non-business expenditure incurred and you are not, expenditures which are incurred partly for business and partly for non-business purposes, and we are not able to identify, then definitely you should use this assumption given by Rule 42, which says that 5% of your common credit will be deemed to be your ITC used for non-business purposes. Now this D2, I would just like to repeat, is applicable only for cases where you are not able to identify whether the expenditure is used partly for business, whether the expenditure is exclusively used for business or non-business purpose. D2 will be applicable only when I have certain expenditure incurred, when I am not able to identify whether it is used partly for, whether it is used exclusively for business or non-business. Hence, it is partly used for business and partly used for non-business purpose. And then you take this presumption that 5% of my total common credit will be my ITC used for non-business purpose. So from my total common credit, I subtract the ITC which is proportionately attributable to exempt supply. I subtract the ITC attributable to non-business purpose, that is 5% of the common credit. And what I derive is the eligible input tax credit. So this is how the derivation of your common credit eligible for claim is made. I'll just repeat the steps once again for everyone's understanding. That firstly, when we will identify what is my total credit, from this I will subtract the ITC which is attributable to my exclusively attributable to exempt supply, exclusively attributable to non-business use, and the block credit. Thereafter, I will subtract the ITC exclusively attributable to taxable or exports, and what I derive here is my common credit. This common credit, I will do a proportion of my exempt to total turnover, and I will derive my proportionate ITC attributable towards exempt supply. From this, from the total pool of common credit, I will subtract this proportionate ITC attributable to exempt supply and the non-business common ITC, and the derivation will be of the eligible ITC, which is denoted by CJ. Now, to understand this in a better way, I'll take one numerical example also. But before this, I just like to deal with some finer points over here. This complicated formula of Rule 42 has to be done each month for entities having exempt income. Final working has to be calculated at the end of the year, taking the amounts for the entire year together. So each month, for example, I start from April. Each month, I will take my total turnover. I'll take my exempt turnover. I will identify my common credit, and thereafter, I will determine what is my eligible ITC. After doing this activity each month, at the end of the year, you are required to once again do this entire activity by taking cumulative figures for all the months together. That is from April to March, and then you need to arrive at an amount to see whether you have done the correct reversal. I mean, whether you have done the exact reversal which was required to be made on an annual basis, or there is a short or excess reversal. If there is a short reversal, then such short reversal has to be paid immediately by reversing your ITC. And if there is an excess reversal made during the year, then such excess reversal can be reclaimed at the time of such annual activity. Now, if there is a short reversal, then your interest has to be paid on such short reversal. Now, interest will begin from the end of the financial year till the actual date of payment of such short reversal. Now, the law says that such final working should be done at least at the max by September following year. It means that for the year April 2021 to March 2022, such working on annual basis should be done by September 2022. That is the GSTR 3B to be filed for September 2022. I should do this working and disclose the excess reversal or short reversal in my GSTR 3B for September. Interest on short reversal will be applicable from April 2022 till September 2022. If I do this activity in the month of March 2022 itself, there is no interest implication. Now, understanding this Rule 42 with a simple formula, with a simple example. So we've taken some numbers over here. Input T1, T2, T3. So input services, which is exclusively used for non-business purpose, is said to be 100. In ITC, exclusively used for exempt services is 50, and input services blocked under 17.5 is 20, and say input services exclusively used for taxable and exports is 500. So the total ITC or the total tax paid on my procurements is 1000, and after and the ITC which is not attributable to any of my business income directly is 330 rupees. This is on my expense side. Now on my income side, I have done an exempt supply in the month of say 10,000, and I've done a taxable supply in the month of say 40,000. So my total turnover during the month is 50,000. So here, if you see, the ratio comes out to 25%. That is my exempt to total turnover ratio is around 20%. Sorry, 20%. So in this example, we'll try to apply this rule 42. So as per the rule 42, first I have to identify my common credit. So common credit, as we understood in the formulas earlier, is total credit, which is 1000 in this example, minus my ITC attributable to non-business use, ITC attributable to my exempt supply, ITC attributable to taxable supplies, and my block credit. So I've subtracted 1000 minus in brackets 100 plus 50 plus 20 plus 500. So what I've derived is the left out ITC of 330 rupees. This 330, I will do a proportion of say 1000 of say this 330. I will do a proportion to derive my common ITC attributable towards exempt supply. The formula says that 10,000, which is my exempt turnover, divided by my total turnover, which is 50,000, multiplied by my common credit, which is 330. So I will get my common credit attributable to exempt supply as 66, which is D1. Thereafter, assuming I have some non-business activity or ITC is used for non-business purpose also, 5% of my total common credit, which is 330, will be denoted as D2, which is common credit attributable towards non-business use. So D1 plus D2 will be my total ineligible common credit, which is 66 plus 17. Then I'll derive my total eligible common credit, which is C3, that is 330 rupees is my total common credit, minus my credit attributable, common credit attributable to exempt supply, which is 66, and minus the common credit attributable to non-business use, that is 17 rupees. With this, I will derive my total eligible common credit in a particular month. This is which is 247 rupees. So this formula has to be applied each month, and at the end of the year, I have to revise this formula again by taking annual figures and identify whether I have done any short reversal or excess reversal during the year. Now, for real estate sector, a separate Rule 42 formula is prescribed. I'm just giving a glimpse of what is the specific formula and what are the areas which need to be taken care of. For real estate sector, this formula is based on the carpet area of the project. You have to break up your carpet area between residential carpet area and commercial carpet area. Further, you have to also break up your carpet area into units sold before receiving OC and units sold after receiving, or units unsold at the date of receipt of OC. And accordingly, your eligible versus ineligible ITC will be determined from the common credit. And this calculation has to be done for each project. A real estate company may have multiple projects going on, but this activity rule 42 has to be applied for each project separately. With this, we complete our apportionment of credit for inputs and input services. For capital goods, a separate rule, rule 43 is prescribed, which says that, which is on a similar footing, but the formula is different. The idea is same, but the formula and the calculations are very different. It says first, out of the total ITC claimed on capital goods. Now here, when we are on this slide, I would just like to highlight that the term capital goods is defined to mean any goods which are capitalized in books of accounts. So your any goods on which you have claimed ITC, which has hit your balance sheet fixed assets, will be termed as capital goods. And the ITC claimed on such capital goods has to be bifurcated into these three baskets again. That is, first, whether it is exclusively used for non-business or exempt supply, then such ITC you cannot claim. Thereafter, the second basket is ITC exclusively used for taxable and exports. Such ITC can be claimed in full. Thereafter, what is left over is common, which is you cannot identify that whether the asset, like your laptops or computers, whether such asset is exclusively used for taxable or exempt supply. In all such cases, there is a separate formula prescribed. Such ITC, here it's termed as TC. TC means the total credit on the common capital goods. Now here the law assumes that your asset which you have capitalized in your books of account, all irrespective of the type of asset, all such asset have a useful life of 5 years, that is 60 months. So what does this formula say? The formula says that firstly, whatever ITC which is there on your common capital goods should be claimed in full. You claim the full ITC, and you also derive a amount attributable to each month. How do we do that? Assuming a life of the asset, say 60 months, that is 5 years, which is mandatorily assumed under the law, which means that 60 months is by default the life of all the asset as per the rule 43, and you take the total credit claimed on such common capital goods, divide that by 60, and you derive the ITC attributable to each month. The law says that first take full credit, and thereafter you apportion the monthly identified common credit, that is your total ITC divided by 60, apportion that into exempt turnover, which is exempt to total turnover, derive a ratio for exempt to total turnover, and multiply that by the total ITC identified on a monthly basis for the common credit. So first step is to claim ITC in full, then identify what is the ITC per month by dividing the total ITC by 60. Identify the ITC attributable for each month, multiply that ITC by exempt turnover divided by total turnover. You will now get ITC per month attributable towards exempt supply. Thereafter, each month you have to go on reversing this ITC. So what will happen is your TR will be constant, but your E divided by F will change each month because your turnover for each month will be different. Your TR, that is your common ITC for a particular type of asset, each month will be same because your initial ITC is identified, which is fixed, which does not change. You have divided that by 60 and identified the ITC per month, and then thereafter you have to do a proportion to exempt to total turnover. So your E divided by F will change each month, and thereafter consequently your TE, that is ITC attributable towards exempt supply, will also change each month. So what does the law says is, law says you claim full ITC in each month. Thereafter, each month you go on reversing the ITC which you have claimed fully by taking the monthly identified ITC into your exempt to total turnover and pay interest on such ITC. Why interest? Because in the first stage you have claimed full ITC. Therefore, you are reversing each month. So pay interest each month. Now this is a very complicated formula again given, and unnecessary interest has to be borne by the business. So many assessees have taken a stand that we will reverse the proportionate ITC attributable to exempt supply in the first year itself from the total ITC of the capital goods. So what does assessees have done is that, for example, if a capital goods has a ITC of 10,000, instead of going into this complex formula which says that first claim 10,000 and then do a monthly working, many assessees have done have taken a stand that out of the total 10,000, I will reverse the entire proportionate ITC. So say for example, my exempt turnover is 25%. I will reverse the entire 2,500 of this 10,000 in the first year, in the first month itself. So thereafter, I did not apply this Rule 43 complex formula. Now, The next topic is the inclusions and exclusions from exempt value. Now, we have understood that what is the formula of Rule 42 and Rule 43, but the Rule 42 and Rule 43 talks about a proportion of exempt to total turnover. What should be included in that exempt value for the purpose of Rule 42 and 43? These inclusions and exclusions from the exempt value are prescribed under Section 17, subsection 3, which says that firstly, whatever is exempt as per the definition of exempt supply, which means that which is either nil rated goods or exempt by way of notification, should be taken as exempt supply. Plus, you should also take any non-taxable supplies which you have made. Non-taxable supplies mean those goods or services on which GST is not leviable. So, which may be, say, for example, your liquor may be non-taxable supply. So, this is the first primary inclusion in your exempt value. Thereafter, Section 73, Section 17, subsection 3 gives a specific inclusion for turnover on which tax is payable by service recipient under reverse charge mechanism. Say, for example, I have certain income from, say, goods transport agency business, for which the tax is payable by my service recipient under RCM. So that turnover on which tax is not paid by me, but tax is paid by service recipient under reverse charge mechanism, such turnover will be considered as exempt for the purpose of Rule 42 and 43 workings. Thereafter, the provision says that your transaction in securities, which means your investments, your investments in mutual funds or shares made by the company, will be considered as exempt for the purpose of Rule 42 and 43. Now, how do we derive the exempt value? The provision by default says that 1% of the sale value, whenever you sell, 1% of the sale value of the security becomes your exempt value. So, whenever I sell the security, so when I procure the security, there is no requirement to reverse any ITC. Only when I sell the security or when I sell the shares or mutual funds, I will be required to take 1% of such sale value as exempt value and reverse the proportionate ITC under Rule 42 and 43. Also, it says that sale of land when part of construction service, that is specifically for real estate sector, where 1/3 value is assumed to be land value, then such value will be considered as exempt for the purpose of GST. Now, what are the exclusions from this calculation? First exclusion is ocean freight vessel transportation income earned by various shipping lines, freight forwarders for export consignment, that is from for transporting goods from India to outside India. All such freight or freight forwarding income earned will be from the sea transportation, that is ocean freight only, will be excluded from the calculations of Rule 42 and 43. That is, I mean to say, it will be excluded from the exempt value. Thereafter, interest income earned not by banks or financial institutions, but by normal business entities, earned by giving loans or advances or deposits. All such interest income will be excluded from the exempt value. Now, recently, the council meeting, GST council meeting, a proposal was made that the duty credit scripts which are sold are exempted as of now from the GST. The council meeting has proposed that the duty credit scripts should also be, the sale value of duty credit scripts should be excluded from the exempt value. Whenever this amendment is made, from that date, probably we can implement this change. Schedule 3 items are specifically excluded. Schedule 3 items mean that high sea sales, your supply of goods from one foreign country to another foreign country without the goods coming to India, supply of goods stored in bonded warehouse under the customs, sale of building, sale of land which is not covered by construction service. All such Schedule 3 items will not be considered as exempt value for the purpose of Rule 42 and 43 reversals. Now, what are the finer points which are to be noted as this? The Section 17(3) inclusions and exclusions of from exempt value have no bearing on your disclosure of GST returns, disclosure of exempt supply under GST returns. Your disclosure of exempt supply under GST returns will be governed by the definition of exempt supply. This inclusions and exclusions given under section 17.3 is only for the purpose of calculating eligible common credit under rule 42 and rule 43. It is not for the purpose of disclosure in your GST returns. What does this mean is that, for example, this transaction in securities, it is not an exempt supply as per the definition of exempt supply. But for the purpose of rule 42, section 17.3 deems such transaction in securities as exempt supply, and therefore, for the purpose of disclosure in GST returns, it will not be considered as exempt supply. Only for the purpose of calculating my reversal ratio, I will reversal ratio under rule 42 and 43, I will treat this as exempt supply. Similarly, my RCM, my turnover on which tax is payable by my service recipient under reverse charge mechanism, for me, such turnover is exempt only for the purpose of rule 42. In my GST returns, I will continue to disclose this as my taxable turnover. So this is the implication of inclusions and exclusions for exempt value under section 17.3. Lastly, we are dealing with a special provision for banks and financial institutions. So this section 17 subsection 4 says that for banks and banking companies and financial institutions which are registered with RBI and which are engaged in the business of giving loans and accepting deposits, for all such institutions, there is an option to either follow rule 42-43, which is the complex formula given, or straight away avail an ITC which is equal to 50% of the total ITC, and rest of the ITC will be lapsed. So here a blanket option is to be given. That is either you follow rule 42-43 and do a proportionate working, or avail only 50% of the ITC, balance 50% will get lapsed, and you're out of this complex formula. Once this option is exercised in any financial year, you cannot change it or cannot change the option during the financial year. You can only change the option in the next coming financial year. Here again, there is a proviso in section 17 subsection 4, which says that this 50% rule will not apply for ITC claimed on account of branch transfers. Branch transfers, ITC can be fully claimed by the recipient branch, and there the 50% restriction will not apply. So this I end my presentation today. There is one query which is raised by one of the participants, whether ITC can be claimed on sales promotion item. Yes, your ITC can be claimed on your sales promotion activities unless it is goods which are given free of cost. So as I said, section 17.5 block credit will always prevail, which says that if there are any goods which are given as free of cost, then the ITC cannot be claimed. For all other expenditures incurred for sales promotion, be it your services or any other expenditure incurred, can be claimed in full, because it is definitely for the promotion and for the growth of my business, and therefore definitely it is in relation to business, and ITC can be claimed. Any other queries which we have on this proportionate proportion of claiming of credit or any other points, we can definitely take it up. So no queries. Thank you everyone for participating, and we'll connect again on the next Tuesday for our topic on block credits. Thank you everyone.